It's critical that ICT traders understand this about fair value gaps. I keep hearing again and again that the markets are fractal. And yes, while the markets do exhibit behaviors that are common between the lower timeframes and the higher timeframes, you have to understand that not all timeframes are equal. The algorithm runs differently on different timeframes, and some timeframes are more significant than others. If you trade fair value gaps, you have to understand what fair value gap is the correct one that needs to be mitigated. And I'm going to show you this today. So this is a tool called Edgeful. Now, if you are one of my subscribers, then there is a link to a free 7-day trial of this software. So essentially, Edgeful provides you statistics on very obscure but powerful trading strategies. And once you are a member of Edgeful, you can also request your own strategies. So this data is for NQ, looking at 3 years worth of information pertaining to fair value gaps. Okay, this is the fair value gap report. And I'm going to show you how not all fair value gaps are equal and what are the fair value gaps you should be using for your own trading. So if we have a look at all the fair value gaps on the 30-minute time frame, we can see only 30% of them were fully mitigated, as in they were fully closed. Now, we can customize this report and say, look, I also care about fair value gaps that are wicked into. Okay, and then what do we see? Only 50% of fair value gaps are even partially mitigated on the 30-minute time frame. Does this mean using a 30-minute fair value gap as part of your entry criteria is high probability for trading the NASDAQ between its open and its closed? No, because 50% of them will not be hit. Fortunately, Edgeful allows us to start breaking down different fair value gap timeframes to see where the algorithm is drawn to and which ones are more likely to be mitigated. So if we then look at the 15-minute gaps, so remember the 30-minute gaps only had a 50% chance of even being wicked into, the odds start to improve. So a 15-minute gap has a 60% chance of being mitigated. Now, remember what your trading gurus on social media tell you. They say the bigger the fair value gap, as in the higher the time frame of the fair value gap, the stronger it is. That is nonsense. You know, I've just showed you that even a 30-minute fair value gap only has a 50% chance of even being wicked into. When we go to the 15-minute, 60% of them are mitigated. So this is the inverse of what people tell you on social media. A 15-minute gap is a stronger draw for price than a 30-minute gap. Now, if we go down to the 5-minute time frame, this is when things get interesting. The 5-minute gaps have a 75% chance of being wicked into. What does this mean? Don't focus so much on the 30-minute or 15-minute gaps. It's the 5-minute gaps that you should be basing your entries on if you had to choose between the 30, the 15, and the 5. These are wicked into 3/4 of the time. If we see if they are fully mitigated, that only occurs 64% of the time. So what have I shown you today? A 5-minute gap is a stronger draw for price than a 15-minute or a 30-minute gap. However, don't expect the full gap to be closed. A wick is more likely than a close. So while the market is fractal, some fair value gaps are more significant for the underlying algorithm than others. If you would like to learn how I trade time and price using my golden bullet trading strategy for index futures, forex, metals, energies, and crypto, there's a link to my mentorship below.